It's been speculated upon for years, but finally it looks like it might all be happening. The winding up of Old Mutual as we know it, and the split into four big chunks. Now the market has got wind of this and absolutely loves it, and we've seen the Old Mutual share price this week rally in anticipation of Friday's results, where Bruce Hemphill, chief executive, new guy in charge, is likely to announce some kind of divvying up of the Old Mutual spoils. The likelihood of this split comes in the wake of global regulatory hurdles, the threat of ratings agencies further downgrading the company, which has already been hurt by the poor credit outlook in South Africa. But 20 years, nearly 20 years, after going on a global expansion plan, the company still makes 65-70% of its profits out of emerging markets, and most of that out of its home market of South Africa. Yet, the wisdom of the forefathers of the current management of Old Mutual 20 years ago thought it was a jolly good idea to go for a jaunt around the United States, go into Europe and buy up insurance companies all over the world. Some estimates put the amount of money wasted over the last 20 years at over 100 billion rand. Finally, Old Mutual may very well be coming home. This is the MoneyMakers. I'm Bruce Whitfield. Tonight, I'm joined in our Cape Town studio by Chris Freund, who's head of SA Multi-Assets at Investec. He's joint manager of the Investec Balanced Fund, to talk about the financial services giant and what a breakup would mean, and what it would mean, of course, ultimately for Nedbank as well. Chris Freund, you've been thinking about this sort of scenario, I think, for quite a while.
We have thought about this for a while. I think it makes sense for the company to split itself. We've in fact been recommending this to company management, who I know have been thinking about it, but it's just been that. They've just been thinking about it. It looks like it's becoming a bit more of a sort of a fact, if we're to believe Sky News announcement earlier on this week. I think it makes perfect sense. I think that Old Mutual doesn't get taken seriously as an investment offshore because the global investors don't really know what it is, in the sense that they don't really know if it's an insurance company or if it's a bank, given their Nedbank, etc. exposure. They don't really know if it's a developed market play or an emerging market play, given what you've just said about their profit split. And so Old Mutual share price has not really garnered much attention at all from global investors. The analysts offshore largely ignore it. The fund managers offshore largely ignore it. And yet it costs them a hell of a lot to be listed offshore. So I think Old Mutual management certainly are wide awake to this, and it looks like they are busy getting ready to do something about it.
I mean, 20 years ago this time, the company was talking about demutualization. When demutualization happened, then came the mad run to London to raise capital to go into the United States and buy insurance companies. That decision nearly broke Old Mutual in the financial crisis, with big bond exposures in the United States. I think it went down to about 4 rand a share. Now it's between 45 and 50 rand a share. Investors have been well rewarded for their patience. But the sum of the parts value of Old Mutual is probably even higher than 45 or 50 rand.
Yeah, I think it is, Bruce. That's why we were anxious that they actually go ahead with this type of restructuring. The jewel in the crown is the London business that they have, the Old Mutual Wealth business, they call it. And it is a vertically integrated financial services company. So what I mean by that jargon is really they have, it reminds me a bit of the strategy that a fellow, unfortunately, who's passed away, Bill Lynch at Imperial, used to do with cars. He used to take bites of the profit all the way up the car chain, and whether it was renting them or buying them or insuring them or financing them or whatever it was. Old Mutual do much the same thing in London in terms of they've got a company that gives financial advice. Then those advisors put their clients' money on the Old Mutual platform. The money then comes out of the platform and goes into the Old Mutual asset managers. They also have a high net worth management called Quilters, a very good company. So all the way up the chain, they are sort of taking bites out of the sort of financial profits. And in fact, that business is growing very fast. So that's the business which, quite interestingly, I'm not sure that Old Mutual management would welcome this, I think, unsolicited bid, it seems like, from two private equity players, global private equity players. I'm not sure they're quite ready to do it.
No, but that's it. I mean, if you're a South African shareholder, you're the Public Investment Corporation of South Africa, who's been very tolerant of Old Mutual's jaunt around the globe for the last 18 years, suddenly when there is real value to be had, now we chop the business up into bits and give the best bits away. Well, the future best bits potentially away.
No, look, I think current shareholders will realize value on sort of the best bits, if you could say that, right now if a deal is done. And, you know, it's possible that the business is split. It's Old Mutual Wealth lists in London, their primary listing, and may have a secondary listing in South Africa. These are sort of deal-related specifics that will have to be sorted out. So if they are, the sort of current shareholders will be able to stay invested in the Old Mutual Wealth business. But Bruce, this I think is a long way from a done deal. I mean, the way we saw it is that the IT systems in the Old Mutual Wealth platform, it used to be the Scandia platform, it's now Old Mutual Wealth platform in their sort of linked service provider business. They're in the middle of a big rebuild of those IT systems, and they are probably about 18 months away from finishing those. And only at that stage was it our understanding that Paul Feeney, who's the MD of the offshore London business, was keen to list. And while I'm at that, by the way, I'm not convinced that the Old Mutual Wealth management team are going to be delighted to be sold to a private equity player. I think they were looking forward to getting shares in a London listed vehicle. So there's quite a lot of water that still needs to flow under the bridge. But there's no doubt that this group is not going to look like it does now in 12 to 24 months' time.
Yeah, I mean, that certainly seems to be the case. There was a lot of speculation we could see a management buyout potentially of that Old Mutual Wealth business, because the way in which it's been reported, we could very well see Old Mutual chopped up into 4 big chunks, and that is the asset management business, a very successful asset management business, the Old Mutual Asset Managers in the United States, partially listed there, the wealth business, Nedbank, and then, of course, the emerging markets business of Old Mutual. It's quite a tidy division of a business, isn't it?
Correct, it could be exactly that, but there are other alternatives right now. They could rather sell the US asset management business, take that money and repay most of their sterling debt they've got in London, about £700 million, and then just proceed with the listing of the Old Mutual Wealth. And then, as you rightfully point out, what do they in effect do with Nedbank? I mean, it's a rare occasion in South Africa that you've got 2 of the big 4 commercial banks in play simultaneously. You know, do they just unbundle Nedbank? Do they find a buyer for it? Or do they just continue with Nedbank as part of Old Mutual emerging markets in South Africa under the assumption that, you know, bank assurance profits, you know, are worth having Nedbank still in the stable? I'm not convinced they are, and I don't think they're convinced they are. So, you know, it's all going to get very interesting.
I mean, bank assurance, B-A-N-C assurance, has always been touted as this magical formula where you've got branch networks all over the place, and people will go into branch networks and happily pick up a form and fill in a life insurance application, hand it into the teller, and you've got yourself a sale. Except that's not the way insurance works, does it? So owning a bank isn't necessarily the way to selling more insurance policies or investments.
No, I mean, yes, I completely agree with you. And I think, you know, over the years, there's been quite a lot of antagonism between Nedbank management and Old Mutual management, but not recently. I might add that Mike Brown and Ralph, MD of Old Mutual South Africa, they have tried hard in the last couple of years to extract those synergies that you're talking about. And even with the best will in the world, I think they're finding out that if you look at the actual rand value of the sort of profits generated from working together, it really doesn't add up to a row of beans. And therefore, does it really make sense for Old Mutual to be, you know, the dominant shareholder of Nedbank? And I think not. And I think they think not.
I mean, regulators quite like big controlling shareholders because it's a nice big capital base to fall back on, as we found out in the financial woes of of Nedbank in 2002, 2003, when Tom Boardman was parachuted in to become chief executive. Old Mutual came up with 5 billion rand to bolster the Nedbank balance sheet. The bank is far better capitalized now than it was then. It's in far better shape. The regulators in South Africa seem to like big gorilla shareholders. Will they be satisfied with an unbundling of shares into the broader market?
Yeah, that's a good question. And I don't know the answer to that. But my understanding is that the banking regulators in South Africa are getting less hung up on the concept of a reference shareholder, as Old Mutual would be for Nedbank. And if you think about it, who's the reference shareholder right now? Who's the shareholder of reference for First Rand? Who's the shareholder of reference for Investec? You know, it's not that obvious these days for some of our banks. And so, but having said that, just a pure unbundling of Nedbank shares in itself would be tricky, because I think there are capital gains tax implications, is my understanding. You've then got a whole lot of the offshore holders who I think would just, you know, create an overhang for Nedbank. So this is going to be tricky. It's going to need people to exercise their minds as to how this unfolds. But you started off by saying something I thought was very correct. You said whichever way you cut it, if you add up the valuation of the various parts, you get to more than the current Old Mutual share price.
What is that number?
And so that pressure is not going away.
What's that number, Chris Freund? What's the number?
Look, I don't know exactly. It depends on all sorts of assumptions. It looks to us like the Old Mutual wealth business in London is worth about £4 billion. If we look at the comparative Rathbones, St James Place, etc. evaluations, and if you sort of build it all up from the Nedbank current share price, etc., you're probably going to get to something just under 50 Rand or 50 Rand a share. And that's using quite conservative valuations. We could push it quite a lot harder than that without being too aggressive.
Is it worth a punt at $45? Could you get 60?
I personally don't think you'll get 60, no. I don't think you'll get 60. It sort of depends on how desperate these supposed two private equity players are to get their hands on what's a very fast-growing business in London. I must point out, however, that not the whole of the London business is growing very fast. They still have what I call some legacy insurance businesses from Scandia that make up about 20% of the London business profits, but rapidly shrinking as the rest of it grows much faster, obviously. So, you know, you can't necessarily put the whole thing on a very high PE, because there's still a portion of it that in fact is going backwards. So no, I don't think you would 60. You could do slightly better than the sort of 50 Rand I've spoken about. But you know, the Old Mutual board is going to have to look at all sorts of options now, and the legalities of how to do it, and CGT, and how to handle offshore shareholders, and the concept of dual listings. And you know, so I've seen simpler things in my life. But it will happen.
Chris Freund, thank you so much for your time this evening here on the Moneymakers. Chris Freund is head of the South Africa multi-assets at Investec, and also joint manager of the Investec Balanced Fund, somebody who's been thinking about how to split up Old Mutual for some time. Thank you for watching. More Moneymakers next time on the show. Thank you so much for watching. Till next time. Bye-bye.